We have a great panel with Matt, Chairman of Investment Banking, North American Investment Banking, and Global Head of Real Estate and Lodging at Lazard. Colin Connolly, President and CEO of Cousins Properties. Christina Chiu, EVP, COO, and CFO of Empire State Realty Trust. And to my right, Ben Schall, former CEO of Seritage and current CEO and President of AvalonBay. We also have within this group members of 4 REIT boards, 2 current bankers, 2 heads, 2 chairmen, 2 CEOs, 2 presidents, an EVP, COO, and a CFO. And with the likely exception of 2 of us, that'd be Matt and I most likely, future long-term leaders in the space. Notably, 60% of this panel is former or current Morgan Stanley real estate members. 2 people worked on the AvalonBay Value Add Fund, and it wasn't Ben Schall. All have been involved with REIT M&A, joint ventures, and activism in one form or another. So I think we have the means and the makings for a good panel. I'm going to start with Matt, since he's here. And to kick things off, Matt, you are on 2 REIT boards. You're also in the boardroom a lot. And so you have a unique window into kind of what's going on and what you're talking to boards about, what you're hearing within the boardroom. Without breaching confidences, what are you hearing in the boardroom right now? What's topical?
Sure. Anyway, sorry I was late, but I thought I was early. Look, the conversations today in terms of out of the ordinary board agendas revolve around capital to start. Public REITs aren't at the moment, generally speaking, satisfied with their stock prices relative to where they think the assets are worth. There's not a big appetite to issue on either on the part of the investor world or on the part of the issuer world. And so the question is, to the extent balance sheets are out of whack, how do you reduce leverage when you can't access the public markets? And to the extent that there are needs for the operations of the business and for growth, where's that capital going to come from? So I would say job number 1 in almost every, certainly public REIT, and presumably many private companies as well, is around how we're going to access capital when the public market isn't overly hospitable. Bond market getting a little better, so that has openings and has opportunities to issue on the debt side of things if you're an unsecured issuer, but obviously the capital markets are dislocated. And then it comes down to the usual stuff around strategy. The world has been evolving rapidly around geographies, property types, where to put capital allocation, if you will, which is one of the principal jobs of a management team as guided or in consultation with the board, and capital allocation. I think many REITs are thinking we can't do what we had been doing. We want to think about other ways to deploy capital in types of investments and sometimes in types of properties as well. So I think that's there. And then there's always a question around what's happening with our shareholder expectations. We live in a weird world where indexes are so dominant and passive, such dominant as a percentage, but not as a voice. And I guess we're starting to see not the real estate guys, but some of the activist names that are broad corporate folks showing up in the registers as we sort of monitor on behalf of clients of companies. And we haven't seen a lot yet, but there's a level, and we don't know whether that's deep value, this stuff is so cheap, we'll just add it to the portfolio, or whether there's some move, because there's not an easy answer for companies to generate a huge sort of uptick with current sentiment and flows. But we are starting to see activist types making investments in REITs that haven't gotten active yet and maybe never will. Maybe it's just deep value because lots of REITs are super cheap. But we certainly keep an eye on it. And you prepare for rainy days in this business, even when it's shining, sun is shining.
And those, sounds like those, the focus on allocation of capital, preservation of capital, what do you do, heightened now just because it's become so precious?
Yeah, I mean, capital's super expensive and you can't get more of it. So those of us, some on the panel who did forward equity deals at yesterday's stock price are sitting pretty in terms of having very sort of thoughtfully and skillfully funded future operations, but you can't refill that bucket at the same level. And it is precious and it's valuable. I mean, we're going into a phase where cap rates have moved up so that, companies want to be on the offense but have to make sure their house at home is taken care of and buttoned up. And offensive capital is often coming from non-traditional sources from a public market point of view.
You mentioned forward equity. Did you use an investment bank on that?
Don't remember, but yeah, we did. Well advised. One of the themes Matt was hitting on, Ron's in my boardroom, so he's heard this from me. But it's an environment where we need to be prepared for a wider set of outcomes. And part of that is making sure we're taking the steps to reinforce our strength, right? So for us, the equity for it is that. For us being one of the more active developers in the space, making sure that we're match funded on the development, inherently just having that capital on hand. So having raised that capital at yesterday's capital cost, right, has allowed us to then deliver a set of projects that are now a driver of earnings for us, but also creating significant value.
Colin, is reflecting back on what Matt said, is he right? What do you and your board worry about right now? And by the way, isn't the office market dead? So what do you have to talk about?
I know Ron thinks it's dead. First, I'll just point out, I noticed, I don't know if you all noticed, but apparently I do own more than one tie. That's a little bit awkward. And apparently Ben doesn't own any ties.
Those are the same shirt, though.
Fair.
Now I'm feeling subconscious.
Yeah. So I'll start just in terms of is the office dead? No, the office is not dead. Although I'm not here to talk about the office, I'm actually an infrastructure company that owns a series of trophy garages with some ancillary office, and that gets a better multiple today. But no, the office is not dead, and in terms of we've gone through a period of the last couple of years where it took a couple of years for kind of the COVID health crisis to work itself out and society to open. And I think at our view at Cousins Properties down in Atlanta, we always felt like it was 2 years in. It's probably going to be 2 years out. And that process has begun. It's hiding in plain sight. Perhaps it's not on the news headline kind of each and every day, but folks like Andy Jassy, Jamie Dimon, and even more recently, the original remote bro, Mark Zuckerberg, has capitulated. And so you're seeing that trend coming back into the office, and we're seeing that certainly in our portfolio at Cousins Properties across the Sun Belt, and in many cases approaching kind of pre-pandemic levels. So from our perspective, the challenges with the office sector, it's really not work from home. That's not something that keeps me up at night. The challenge in the office sector is there's just too many old office buildings. And the market's in a process of rebalancing itself to find kind of a new equilibrium. And the customer base, in terms of the buildings that they choose, and the capital markets, which the buildings in which they're willing to finance, are dictating outcomes that are going to result in a smaller inventory of office buildings, with very few being added as it relates to new supply. And so if you own a trophy portfolio of buildings like we do throughout markets like Atlanta and Austin, we kind of look forward to a rebalancing and actually a healthy market in just a few years. And again, you look at a sector like the retail sector, they just went through a similar process. 5 years ago, if Connor Flynn were on this panel, he would be, he was the office guy. I think today, right, that market has rebalanced, and we're pretty confident you're going to see a similar rebalancing play out in the office market.
Christina, maybe just picking up on that, Empire State Realty Trust owns the iconic Empire State Building, over 2.5 million square feet of office space, and then, of course, the world-famous observatory. COVID and work from home changed things materially for your business, and it's gotten a lot more complicated than just collecting rent and having tourists pass through the turnstiles. What have been the biggest shifts in terms of managing Empire State Realty Trust for you?
So I joined the company in May of 2020, so if we're keeping track of dates, that means I joined a New York City office company with components of tourism at the top of COVID. So some would question my intelligence, but it's been a good ride. So joining at that time is meaningful because it represented sort of a fork in the road for the company, right? Stock trading at all-time lows, capital becoming scarce, tenants questioning whether rent was optional as opposed to contractual, and across sectors they tested that, and in courts it's, you actually have to pay the rents even if you're not occupying the space, and so a lot of things were in question. So job number 1, 2, and 3 was all about capital allocation. And the capital allocation is broken up, in different components. I'd echo a lot of the comments made here, but the first and most important is operating runway. So during COVID, what was interesting versus now is the availability of capital was very, very cheap. The question was, were there certain segments that were redline and people were very uncertain? So we had to create an all-weather balance sheet. What does all-weather mean? That means it stands the test of time in debt dislocated markets like today. It stands the test of time when you have COVID and the world is shut down and the observatory, which was 25% of the company's net operating income, was gone. So some of the measures that we took included getting our line of credit done very early, as soon as the opening for saying office and an investment committee reopened, credit committee reopened. It included accessing CMBS debt because as much negativity as there was around office, we were able to get 10-year debt at 2.8%. So very big difference between sentiment and access to capital. We eliminated all floating rate exposure and we staggered our maturities, so we have nothing coming due until end of 2024. So operating runway, very, very important on the balance sheet side. The second component was dividends. So, I joined in May and we paid a dividend. The yield was high single digits. And with the observatory closed, we did not have a tax requirement to pay any more after mid-year. And so we discussed with the board, should we consider a temporary suspension? And this was an odd situation because we had the cash. We had, hundreds of millions of cash, but we're debating whether to suspend the dividend. And we said with a quarter of the business closed, that seems to make sense because, again, survival is number one. So we temporarily suspended, way over-prepared for conversations, and as it turned out, the market pretty much understood. They said the world is uncertain, portion of the business is closed, so we got a quote-unquote pass. Then came time to bring back the dividend. So we reinstated a few quarters later, but we brought it back at 1/3 of the historical rate with an eye towards the observatories recovering, and again, operating runway and stability is job number one. And along the way, we also had a $100 million net operating loss carry forward. And that comes into play because when you look at an environment now where it's capital scarce, that's a source of capital and it's more valuable now than before. So that's on the dividend side. And then on share buybacks, right, with share prices being so cheap, I think most companies are evaluating it, if not already doing it. But then that comes against alternatives such as investing in the business that grows further cash flow and taking advantage of opportunities. And also, capital is scarce. So we, since 2020, we started the buyback program and repurchased 11% of our total shares outstanding. So it's definitely a strategic part. But entering into this environment, you have to think about how do you continue to do that without weakening the balance sheet. And then the final piece is capital recycling. So, coming from the buy side, I'm very sympathetic to this, which is all companies should take a hard look at their assets and consider disposing of assets that are less core to the business and serves as a source of capital for other priorities within the business. So with that in mind, 2013, the IPO to 2019 was very much a redevelopment story for ESRT. We took older vintage assets and made a deliberate choice to put a lot of capital in to modernize and make them competitive, and now they're ready to go. And so we should consider whether we should sell some. So we've disposed of 5 non-core assets and redeployed into multifamily. And that's the last piece, which is multifamily was new to ESRT. So, the REIT sector likes to think about pure play. So that was a tough question for the board and management, which is whether we should enter a new space. And in our view, we already had the observatory, which was 25% of the business, benefits from tourism. So we're not just an office company. And then we have the base building, retail. So if you already have office, retail, and tourism, we're already not pure play. And when you think about the drivers of New York City, the fabric of New York City is really office demand, retail demand, tourism, and residential. And so to us, that made a ton of sense, and we brought that into the portfolio. So I'd say there's a lot of sort of strategic shifts. They vary with time, but the capital piece is incredibly important.
Okay. I'm going to come back to a couple of things you said, but you also mentioned multifamily, pure play. Ben, your stock is trading pretty well on a relative basis. With that said, what are the primary topics in your boardroom, and might there be any interest in an office merger with anybody?
I'm not sure I would go there. We actually are active in the office arena, but it's primarily defunct suburban office that we're acquiring for the land and then converting that over. That's probably a quarter of our development pipeline right now. In terms, I talked briefly before about kind of steps we're taking kind of defensively, strengthening our position. Another big aspect in the boardroom is a time like this is, could be opportunities that present themselves, particularly for somebody with our strength, with our balance sheet. And I feel we are entering that environment. You heard it on some of the panels this morning, that an environment where the REITs, at least in the multifamily sector, are now have an advantage relative to the private players. And our cost of capital has risen. I'll use just borrowing costs as an example. We used to borrow 10% money at 2% fixed.
10-year money.
10-year money at 2% fixed. That number is now 5%. So gone up significantly. But you compare that to the private sector, their cost of, you talk about a merchant builder doing a new construction loan today, that senior mortgage is 7.5% to 8.5%, right? That's before you get into what the cost of the mezz is or the cost of the equity. And so we are starting to see opportunities present themselves. We're selective right now, but to give you a couple examples, markets where we've got a great presence, we know the markets well, we know the towns well, or places where we're looking to grow in some of our expansion markets, we're finding land opportunities right now that are 30 to 35% discounts from where they were priced a year ago. So there's that side of the business. I'd say one of the other key themes for us and in the boardroom is, there's a lot of uncertainty in the market, right? There's uncertainty on where cap rates are going to settle, right? Where multiples are going to settle. So our focus in that type of environment is how can we drive cash flow, right? And so we have a unique growth driver. I talked about development before. We've expanded that to providing capital to other developers, effectively leveraging that skill set, creating additional earning streams, but also a lot of focus on the operating side of the business and driving margins there. We may talk about technology today, but we're going through a fairly substantial digitization of our business, and our target is to improve margins by 200 basis points there. So we're always focused on that, but I think particularly in times like this, our ability to grow those that earnings are crucial.
You mentioned buying land and developing it. How do you, in this uncertain environment, how do you think about, is it a spread to where you think cap rates are going to be or are, or how do you assess that?
That is exactly it. Sort of our focus is we want to maintain between 150 to 200 basis points of spread on where we can develop, a development yield relative to underlying cap rates. And if we can do that as well.
Yield versus IRR.
Yield versus a cap rate, so a development yield, kind of cash on cost development yield relative to that spot cap rate. Then the other critical component of it, if you're going to do that, you also need to think about matching your cost of capital that period of time, right? So what you don't want to do is think that you have a return, a value proposition there, but then be short on the capital or have your capital cost change as you're going through that project. So we've been able to do that over a very long extended period of time, and it's proven out that we then can create value throughout cycles.
Okay. Matt, back to you, because it's come up, the word pure play has come up amongst what some of our panelists have been saying. Do REIT investors want pure play? There was a discussion last night from one of the leading REIT investors who queried whether investors want pure play. My experience is they do want pure play and they can allocate themselves, but tell us what you think on that topic.
Look, I think no REIT is as pure as they describe themselves. So even a big office REIT has some parking, has some retail, has some ancillary uses along the way, is holding some development land. But I do think that the public market has always wanted a major and will accept some level of minor if it's rational and it makes sense and it's in your geography and your sphere, particularly around mixed-use development. But I still think you have to major in something. You can define that. So the healthcare REITs, by way of example, are pretty diversified across property types that have something to do with the provision of healthcare, but it could be medical office, life science, senior housing, nursing. There's a lot of varieties, and that's a pretty diversified model, some debt, some equity, mostly equity. But for the traditional property types, for the most part, you've had some convergence with cell towers and data centers and in the recent past. But I think there's got to be a thematic, a demonstration of core competency and a thematic sort of consistency. But I do think most investors want simplicity and an obvious major. And I think, look, the company's cost of capital is effectively some combination, and we can talk about this in other contexts, of your cost of debt, your cost of equity. Your cost of equity, to the extent it's simpler and easier to quantify in terms of projected cash flow, based on some view of management's capital allocation, balance sheet, and everything else, gets a lower discount rate than it would otherwise have. And I would argue that REITs are in the business of having the lowest possible discount rate on their cost of capital. And one tool that's pretty easy to follow is having a simpler, more understandable set of cash flows. You may not like it. Like there was a time in the malls where you didn't like the cash flows, but to the extent you understood it, you can apply all things equal a lower discount rate to it. And I do think from a company issuer point of view, having the ability to be a bit more predictable is valuable in the form of a lower discount rate on future earnings. And most, though not all, REIT buy-siders, who are a minority of the market today, will tell you they want to do diversification themselves. They want to have a basket that they fill with the items that they want to shop for, and they don't want the other stuff. And they'll discount you in the same way. On the corporate world, we used to talk about conglomerate discounts, where most conglomerates, most of the time, trade at a discount to the sum of the parts. Now, most REITs trade at a discount to the sum of the parts, too. But to the extent there's more parts, difficult to understand, you have less of a chance of outperformance when your property type or your strategy is current and is popular.
Guy, where our worlds are coming together is the world of office to resi conversions, right? I think the worlds have been together a little bit around mixed use. Colin and I actually tried to figure out a deal together to do that, and we didn't quite get there, but we'll figure it out at some point. That version of it is sort of larger sites, kind of creating a place, right? He'll execute the office, we'll execute the multifamily, create some synergies there. I think that's been done. Maybe not within a single company, but done in partnership. But the world of kind of office to resi conversions is sort of increasingly interested in kind of your guys' views on, I think that's actually realistic, kind of under what situations does it happen? I can share some thoughts.
Well, it's certainly, there's some small percentage where you can facilitate that and create a positive outcome. I think that they will be proved to be harder to execute, and probably in some cases need some public support to do that. But from our perspective, 10 years ago, Cousins was a very much a diversified REIT. We were in the office business, we were in the retail business, the multifamily business. We were all things real estate in Atlanta. And we set out upon a path 11 years ago to, candidly listen to our shareholders who said, we want to invest in a team that had a specific edge in a particular style of investment. And so we looked at our business and said, we have an edge in the office sector with our local and corporate relationships. And so over a period of 11 years, we have simplified the business candidly into an office business focused on really two big trends that we saw a long time ago, which was a migration to the Sun Belt and a flight to quality. And we've positioned the entire company around that. And so, as we sit today, our view is we're in some cyclical trends as it relates to office usage, but we're seeing very positive signs of that kind of rebounding. But we still believe in those secular trends, and so from our perspective, we don't feel a lack of conviction to continue to invest in our core business. We will, from time to time, find ancillary adjacent uses like multifamily. Perhaps we'll partner with somebody like AvalonBay. Perhaps we'll do it ourselves. And so I think there'll be specific transactions where our overall focus and our competitive advantage in kind of urban trophy office will create some small opportunities, and we'll pursue those. But by and large, we very much still believe in our business plan, and we believe in those secular trends that are going to continue to drive great outcomes in places like Midtown Atlanta and downtown Austin. And
I'll just add a comment on New York City office to resi. The topic is widely asked and discussed. And, in our view, some will get done. A lot of it depends on how the government cooperates and provides incentives. But really what it all comes down to is basis. You have to get in sufficiently low. Government providing tax benefits and incentives can help, but you have to get in sufficiently low because the cost to convert is very high. So just to provide a couple of specs, right? When you look at an office building, if you want a bedroom to count as a bedroom, you need windows. So all that interior space does not lend well for bedroom count, which is a huge driver for resi value. Number two is HVAC and plumbing. You take a 4,000 square foot office, that's a pretty small office, right? They might get their own pantry, they probably share a bathroom, and that's like a handful of water fixtures. You turn that into an apartment, and we know New York City apartments are not very large. 4,000 square feet can probably squeeze in 2 smaller size 3 bedrooms, but even there you're talking, a dozen plumbing fixtures, right? Between bathrooms and kitchen, dishwasher, washer and dryer. And then now you're working within the 4 walls of a building. And most would say to get it efficient, you want to create a core in the center, you want to move the elevator somewhere efficient. So when you get through all of that, the numbers really add up. So even if you have an obsolete office, you get in, then you have to pay some form of demolition costs, and you're working within the 4 walls. And then you have a loss ratio, because the way you use space in office is very different from resi. So I think the narrative is far ahead of the actual execution. Is it a good idea because resi demand is very strong in a vibrant city like New York City? Yes, but it takes a lot more to bring that into fruition. And I think this calculus will vary city by city.
That's well put.
Christina, just touch a little bit more on residential and Empire State Realty Trust, and what does the company look like, say, in 5 years from now? And I think you've made a mark, which is you're going to start doing more multifamily. So tell us about the thinking behind that, and did investors applaud that or not?
Sure. So multifamily is about 5% of our net operating income. So it's a small start. We have a little over 700 units. So nowhere near scale, but we've very clearly communicated interest. So I would tell you, we went in eyes wide open that the market is not going to like it because, well, when we previewed them that we might do multifamily, they said we're really not going to like it. So we went in eyes very wide open. So the questions for us were, is it logical? So as I mentioned earlier, even though we're classically classified as an office REIT, we already were not, right? Observatory made up 25% of net operating income. That's clearly tourism driven, and we also have retail. But we understand we're in that bucket. So the question is, can you add something that is logical and has long-term strategic merit? So it's important that it's not an orphan. If we're going to do one and done, probably not worth pissing off the market and doing something that's an orphan. But if you see a path to a strategy, if we will continue to recycle and have our eyes open to New York City office, retail, multifamily, and now we've just expanded our opportunity set, that seems quite worthwhile. So this is not a random choice. This is something where we see a path forward. The second point that we debated is, as much as you have a number of office REITs here, there's little or no pure plays actually remaining. And I would put BXP in there, right? They've done a phenomenal job. They have life sciences, they have different markets, some mixed use. SL Green has long not been pure play. They now want to do casinos. They have a debt book. Vornado has long not been pure play. And they've gone the gamut. I would put Cousins in that category. JBG, 50% multifamily. We moved to the West Coast. You've got Kilroy with life sciences. They have San Fran, and now they have Austin. HPP going into movie studios. And then Douglas Emmett with multifamily and based in Honolulu. So when you go through the math, as much as there is this concept that, don't diversify, be a pure play, I would ask two questions. Who actually is pure play? And the second is, suppose we were pure play, would we get a better multiple as 100% office? Right? So I think ultimately, it's not really about who wins the argument, it's about the execution. So whether we win right now, that's the short term. In a few years, the way we win is by saying how much did this become as a part of the portfolio, and with the deals that we did, was that a good choice or not? And the last thing I'll say is, as companies, publicly traded companies, our audience, and apologies to the equity investors in here, are not just the equity investors, right? We have stakeholders, and that includes our lenders. So as much as analysts and investors did not love it, the lenders loved it. To them, multifamily is a favored asset class, has differentiated access to capital, especially with agency financing, and it's a source of diversification. And to fast forward, I would say the narrative for us has migrated from don't do it, we hope you don't do it, people aren't going to like it, to I get why you did it, it's a New York City focus. The question is, given the cost of capital discount that the office REITs trade at, and given the differential in cap rates between multifamily and office, how will you do more? Right, so there's a shift, and I think ultimately companies have to be aware and respectful of how the market will perceive it, but they own that decision in terms of execution and whether that translates into results.
Do you think about operating efficiencies? Like, do you think about the geographic concentration and being able to operate a cluster of multifamily assets in office? Is there any crossover there?
Yeah, that's a great point. So with multifamily, we are not at scale where that's the case. So in that instance, whereas we are vertically integrated on office, we actually have third-party property management for the 3 multifamily assets that we own, because at 721 units, that's not scale, and it's actually quite common. So we do all the asset management and have control and decision-making and capital structure. However, boots on the ground, we have someone else. I think there will come a point, especially as a public company and especially when you get to scale, where that makes sense. Something else you touched on that resonates with me is on the fact of technology. We want to use chatbot and something that moves more into AI, and Meet Elise was high on the list, and I know you guys are great partners with them, but at 721 units, it's not cost efficient, right? So there are things you miss on the ramp up, which is why it's even more important that these are not orphans. Like, you have to have a view. You don't have to be there now, but you really have to have a clear view on how your margins shift over time as you build scale.
Colin, you've had a history of doing things in partnership or joint venture with institutional investors, with your tenants.
Almost with Ben.
Almost.
Yep.
Toby got involved.
Yeah.
And I think you actually just entered Nashville in a joint venture format. Talk about how you decide, are you doing it all on your own, or are you going to do it with a partner, and it doesn't, doing it with a partner, particularly somebody like Ben, overcomplicate things?
Well, in the situation with Ben, it's funny, we were laughing, we were working on something together, and then I hadn't heard from him in a while, and this was kind of, rewind about a year ago, and been a few months, and I called him up and I said, "It feels like you're quiet quitting on me. Is that is that right?" And but we'll figure something out down.
Land bases had moved.
Yeah. So at Cousins again, everything kind of comes back to the customer, and again, we've got a view that there are more customers moving into our Sunbelt geographies, and they want higher quality product, and we pursue any interesting transaction that we can find, whether it's an acquisition, a development. We can talk about some other types of transactions that we've done that can create a great investment return along that thesis. And so, we did just enter Nashville, a market that we like long term, that we think has a lot of similarities to a market in Austin, Texas, that we've been in for 20, 25 years. And so we found a creative way to enter that market with another institutional investor who was partnered with a developer who had a project that was kind of bigger than they could handle. And somebody we had done business with, and they called us up and said, would you take half of this transaction, this development project? And we said, sure, but we also want you to sell us another building in Atlanta that you own that we like. And we created kind of a really interesting transaction. So from our perspective, we have a very strong balance sheet, low leverage, a lot of liquidity. We typically don't need a partner from a pure financial perspective, but we will partner with somebody that has a financial partner or a strategic partner if there's some value add that partner is bringing to the company and our shareholders. And so we've pursued and executed all number of types of transactions if it's along that line.
Okay. Ben, almost 20 years ago, Christina and I worked on and created the AvalonBay Value Add Fund. Yeah. Fund 1, and then there was Fund 2. I said 20 years ago. Christina looks a lot better than I do 20 years later. But AvalonBay exited the fund business, and but now you've done some joint ventures, yeah. And you have a structured investment program. So why did you exit the fund business, and then why have you re-entered in the current format?
Yeah, the fund business and sort of the history there is it made sense for that point in time. And part of that was there was a fairly extended period of time leading up to that where AvalonBay really didn't have access to the public equity markets. So there was that component of it. It did, I think about kind of the history of AvalonBay, it did allow us to build a set of strategic capabilities, right? I mean, this is 20, 25 years ago. Back then, we were really, really led by development. Didn't necessarily have in-house the acquisition team or capabilities or the value add team and capabilities. So it allowed us to develop those. But the short version is, both of those funds were successful, but we made a decision then to effectively wanted to bring that fully in-house and be able to utilize those skills for the mothership. It is, the joint venture model is a tool we have used and continue to think about. And there's a couple of potential areas where we think there's a fit. One is around portfolio allocation. So as a kind of leading example of that, we have a large joint venture on a number of our New York assets. And that decision was made 5 years ago where we wanted to lighten up our load in New York, but we thought there was value in maintaining our people on the ground and that presence. And that's something that's increasingly, in my mind, kind of increasingly true in the multifamily space, which is, and it ties back to technology and the density, what you're getting at, which is there's increasingly benefits from effectively having a cluster of assets in terms of how we manage those assets. The old model of multifamily was dedicated teams at a site. We are now increasingly moving to managing a neighborhood of assets and utilizing technology to do that. So the joint venture program allows us to achieve our portfolio allocation objectives, but continue to have that clustering dynamic and a clustering benefit. So that's been useful, and it is something we potentially could use going forward. The second arena is eventually a way to enhance growth. And we have used that on the development side, and it's potentially we could use that in the future. And it gets at the reality, we're talking about kind of the REIT model. The reality is our access to the public equity markets is fairly sporadic, right? And so at times having access to private capital to be able to continue to grow and tap into opportunities could be a fit.
And tell us about this, and I like what you just said around the private capital plus public capital, both debt and equity just gives you a broader range of capital, more diversification of capital, which in this environment's probably better. Yeah. Tell us about this structured investment program. What's that for?
Yeah, so there's, as we've been thinking about taking our development DNA and leveraging that further for growth and value creation, we looked at it and we said, okay, what are the ways that we can effectively provide additional growth opportunities? And really there have been two programs where we've leaned in. One is which we call our developer funding program. There we're most of the development we do ourselves. There we're actually providing 100% of the capital to merchant builders and allowing them to, if they execute in the way and the market winds up executing the way that we expect, they'll earn a promote. but we own the asset fully. And we've been utilizing that in our expansion markets as a way to get increased concentration more quickly than if we were just doing it ourselves. The second is our structured investment program. And there we're only providing a piece of the capital. And it's on new construction deals in our markets, and we're providing preferred equity and mezz on those deals. And our thought process there, kind of us of anyone, given how much we understand development, how much we understand construction, we can bring our teams who are living and breathing the construction markets every day to give us an honest assessment of how do we evaluate the risk on somebody else's deal. It allowed us to take that skill set and that in-house knowledge, provide the capital to others, and we think get an appropriate risk-adjusted return.
Matt, are you seeing more of that, or in your discussions with people thinking more about broad range of capital and more private capital?
Yeah, I would almost think that's job one across the REIT sector is public and private debt and equity, and accessing capital when and where you can opportunistically. The cost of traditional regular way equity and debt is volatile, to say the least, and there's not much depth in the equity markets, even if you like your screen price one day, to move enough stock to make a difference without pushing down the price that you issue at. So I think for sure. Now, the multifamily guys, some senior housing, have the benefit of agency availability, which is a wonderful sort of anchor in the debt markets on that side of things. But for sure, many of us in the financial advisory world are spending time in the Middle East and in Asia and in the pension land around trying to bring private capital to sort of plug holes where it makes sense. And look, being public started out as a very exciting game in the 90s where you were recovering from a recession and you could enjoy a cost of capital that was accretive by buying private assets using public currency. And for the last 2 decades and change, maybe more than that, that's been sporadic in terms of moments in the cycle for traditional property types. You've had the emergence of these tech-oriented REITs, which aren't really traditional real estate or don't respond to drivers of demand that we think of traditionally for real estate. But today, I think healthy companies have multiple ports of call for capital. And you talked about a go-anywhere balance sheet. I think that's the name of the game. The activity we're seeing in the markets today are folks who, for one reason or another, didn't do the go-anywhere thing, and they're stuck. And so, to the extent you're seeing transactions form, it's not because somebody woke up and said, today's the right day to do this deal. It's because the capital markets are driving a particular strategy that isn't necessarily what the strategy would have been absent capital pressure.
Okay. I want to come back to that, to something you said in just a moment, but Colin, you've also transformed and diversified Cousins properties through M&A as well. Tell us about the pros and cons of that strategy for Cousins, and do you expect to do more of that going forward?
We'll see. We've done over the last 10 years a couple different corporate transactions. We merged with a company by the name of Parkway Properties and spun out a standalone public company by the name of Parkway Properties that was entirely focused on a Houston portfolio. We merged with a company by the name of Tier REIT, I guess 2019, all advised by Wachtell, by the way.
There's a reason why you're up here.
What's that?
There's a reason why you're up here.
That's fair. I just figured that out. But so we've pursued those again in a focus of trying to build a Sunbelt trophy office REIT with a terrific balance sheet. And as a public company, you do have some advantages relative to some private companies. And again, the breadth and width of the different capital alternatives. And so we've found ourselves at different times with similar type companies where we had a cost of capital advantage. And so we put those businesses together to take two separate businesses and make a stronger singular business. And that's been very effective for us over the last 10 years. But the cons of those transactions are they're complicated. And I think they can be complicating for our investors, who I think typically prefer simple over complicated. And they take time to integrate and bring those businesses together and create a common culture and common operating practices. So we we're always looking out and trying to find opportunity, and whether that's private, whether it's public, again, to go build this dominant Sunbelt trophy franchise. And so when there are times when you've got a cost of capital advantage and there's an opportunity to grow the business in that way, we'll look at all creative ideas, and so we've done it in the past, we could potentially do it in the future.
So not wed to a particular strategy or particular market or particular deal, just being somewhat opportunistic, I expect, particularly in the environment in the next few years.
That's right. And I think, again, it's going to be interesting. There's certainly, as you think about public to public M&A, and I think you're going to see, over time, you're going to see some of that happen. I think it's going to be out of necessity, as Matt's alluding to, where there's some folks where capital has been shut off. I think in certain sectors, as the debt markets open up, you'll see some public to private activity. But Matt alluded to it, in particular in our space, where we've been trading at such a massive discount to NAV. You would say there's no way you can actually use your public currency. But I think we're going to see over the course of this year and next that the cost of capital in the private office sector is going to be so severe that one could make an argument that we'll be back in the early 90s, where public office REITs are using OP units to consolidate assets in the private market and actually use your currency, where the private markets actually might trade wider, if one could actually believe it, than where the public market is trading today.
Yeah. Well, I think you might also see in the next couple of years the ability to use units to shield people's tax, because I think what's going to evolve out of this, particularly in the office sector, a lot of asset givebacks or workouts, is the developers saying, I got a tax problem. I don't want to give up my asset, but I can take some units. You mentioned discounts to NAV, and Matt, you had mentioned that financial advisors and CEOs are kind of talking to people around the world about where their stock, probably not where their stock price is, but wanting to sell assets at NAV to either redeploy or repurchase stock. And so, yeah, I think if you can go back 30 years now, we have pretty good data in the REIT industry, or have accumulated good data over 30 years. And public REIT stock prices for 30 years have led private values, or the implied cap rates of the public REITs. If you track it 30 years and then you look at private cap rates, the REITs have always led, sometimes a little too far on the down and sometimes a little too far on the up, but they have always led. So if that's the case, then what's going to happen in the next couple of years? Because I think this is, I may get this slightly wrong, but if I look at the top 25 REITs by market cap, FFO per share growth between 22 and 23 is projected to be positive for 23 out of 25. And for the two that were negative, it was marginal. But of those 25 largest REITs, 23 of them, their stock price is down on average almost 30%. And so what does that mean in terms of public to private? And when financial advisors and CEOs are talking to capital sources, wouldn't the smart capital source say, well, why do I want to buy the assets? I should buy the stock price.
And a lot are actually doing that. It's amazing how many sovereign wealth funds today, in discussions around a real estate deal, will respond with the obvious but seldom said, why would I buy the asset when I can buy the stock at a 25% discount to what the asset is being offered for? But look, the public prices the future value of cash flows, and the private market values something else. If that's a real market at the moment, or in times like this, there isn't enough transaction velocity. Sellers get sticky and buyers are waiting for a better deal, and so you have very little transaction velocity to say what is private market. I think the public market does a pretty good job of predicting, if you had to sell a lot of assets into an illiquid market, what would you have to do to clear the market? Which is a different question than what could I sell one asset for at one cap rate to one particular buyer with a set of assumable or not assumable financing or anything else. Obviously, each transaction is unique from both buyer and seller's perspective. But I do think the public market, when you buy a stock, you're buying consensus estimates of future cash flow. And I think it makes sense that stocks went down because cost of capital went up. And so you grew 3%, 4%, 7%. The value from a debt point of view and from an equity point of view, cost of equity and debt are up 200-300 points, certainly on the debt side, equity 100 to 200. If you assume those were durable changes in cost of capital, and equity reflecting volatility and maybe less growth going forward than the past, and debt just spreads in an illiquid debt market at the moment for many types of real estate, not all. That knocks half the value off of, an early, a pre-downturn number when the Fed started raising rates. So you're down 50% if that's the case. If you think that's going to be temporary and come down again, you're down 25 or 30%. That's just math of the discounted value of future earnings based on higher cost of debt capital and higher cost of equity between 100 and 200 points. And we sort of internally refresh this analysis broadly, pretty regularly. And so it doesn't matter that your FFO went up as much as it matters that the present value of those future earnings are just worth less today relative to what market cost of capital is. And from an NAV perspective, it matters a little less in an ideal world on sort of stock-for-stock mergers in terms of doing deals because that's about earnings accretion and value accretion from a lower base, but comparable for two sides to a transaction. But I think it's been years, and there's been much debate about this, and there's constant debate in the boardrooms. What does NAV mean as a valuation metric? And I think Lazard has been maybe slightly on one side of this debate of looking at NAV and understanding its importance. But an investor, when you buy a stock of a company, you're not buying the assets, you're buying the stock, which has a balance sheet, has a management track record of capital allocation, has an overhead component. The cash flows available to the stockholder, either in dividends or earnings, is different than the cash flow available to a buyer of an individual asset financed privately. And so we obviously want to understand NAV, and there's tax elements, and there's a big difference between net realizable value and net asset value. And this is the stuff that we spend a lot of time thinking about analyzing sort of case by case. But when you buy stock in a company, you're not buying the assets. You're buying an earning stream that's affected positively or negatively by the corporate strategy, balance sheet, and ability to smartly allocate capital over time, or less smartly. Either you add or subtract value. Green Street has a table on their estimates of that sort of thing. So it's not that I don't think NAV is important. I just think stock's not NAV. And we've been involved with lots of situations where the view of the board and the bankers was what's available to the stockholders in a different series of transactions is not NAV. There's no strategy which gets NAV to the stockholders, and therefore an alternative strategy that may generate a material premium to where it trades, but less than stated NAV, still a smarter thing to do for shareholders than status quo, and that's the test that you use. So I think NAV is a little bit antiquated, and frankly, as much as we love the REIT mafia that sort of brought us to the table here in terms of the IPOs, they have relatively little influence, value investors, relatively little influence in the market, and so the price isn't being set anymore by the NAV crowd of the stock. It's being set by much larger forces in the generalist and the index world.
That's terrific. Good insights. Just one final question for this group. And Matt, you talked about cost of capital and its impact on stock prices and present value of those future cash flow streams. And I think the biggest influence, and we forgot this, but we're reminded in the last couple of years, and probably for the next couple of years, the biggest influence in the real estate industry is interest rates and cost of capital and availability of capital. And I was trying to see if we might be able to choreograph some sort of office apartment merger, three-way something, but that's clearly not happening from a prediction standpoint. But I am going to ask each of you to predict where is the 10-year, which I think is the benchmark for cost of capital in the real estate space, but where is the 10-year Treasury going to settle out? Not necessarily when, but where, and what does that mean for cap rates and your stock price?
I'll take the I don't know as the primary answer, but I do recognize, and I think it's important that we plan for a environment going forward that is a world of higher rates. And so for us, one of the focus areas is, and I talked about land getting retraded, and we've got a significant development pipeline. A lot of those deals were cut a year and a half ago. So we're very actively going through and restriking those deals, and where we can't, walking away to then create room for the next set of opportunities that will present themselves based on today's environment.
So you're not going to answer the question?
I'm not going to answer the question.
All right, my former colleagues, you'll answer the question,
Ask
right?
the former bankers. Yeah.
This is like a fool's game trying to answer this. So I think it's interesting watching the Fed, a large extent to where things, quote unquote, stabilize or test depends on how badly they break things. Because if they break things bad enough, they probably go back to how they fixed things in the past, which is to cut rates. And then you restabilize coming out of that. Having said that, maybe they don't want to test rates at ultra low levels. If the 10-year was around 4%, I would not be entirely surprised. I think the tougher part is spreads. As real estate get repriced as, not only did the benchmark rates go super low in this last 10-year cycle, but the spreads got super thin across the board, and everyone was willing to underwrite growth. I wonder if lessons will be learned. So I think, cap rates north of that being whatever, 5, 6, 6.5, depending on asset class, that's not unreasonable either. But regarding share prices, I do wonder whether the pendulum has shifted so much towards being in favor of private capital. That money has to go somewhere. So far for office, right, trades at massive discounts to NAV. Does NAV matter? But if you're a large opportunity fund and you're putting money to work, assuming the debt markets cooperate even a little bit, you're going to look for an entry price. And if public markets provide a better entry price, they might come in. I don't know if it gets to NAV, but some of that, arbitrage could close.
Well, it'll get to NAV as NAV comes down.
Yes.
It's not going the other way.
Yeah.
Right, I think that's right.
So anyway, it's a long-winded way of saying, share prices influenced by value of real estate and cap rates, but I think share prices have probably reflected more than any of the above being down.
Colin?
I think we're out of time. Yeah. He's still looking at me, so I guess. You failed on your merger, and I think you failed in getting anybody to say a specific answer. I don't know. I'll tell you that we're running our business preparing for higher for longer. I think we've all been conditioned that as the market softens, the economy softens, the Fed cuts. I think inflation will prove to be more challenging and tricky. And back when I was running Cousins in the 70s, I'm kidding. I was like 6. But there was a time where rates were higher and the economy was soft, and the Fed wasn't cutting. And I think we certainly are preparing for an environment like that.
Yeah, I'm with Colin. I think inflation will be more persistent. Just fundamental deglobalization, labor shortages. There's a sort of list of things that suggest inflation's higher, which means the Fed sort of has to stay higher longer. So I don't know where rates are, but it's probably closer to 5 than to 4. And maybe it gets worse than that. I doubt it, but if I were to bet, I'd say it rounds to 5.
I'm with you. With that, I think we're out of time. Thank you.
Yep.